Most people are afraid of the stock market. And honestly, that makes sense. It sounds complicated. It looks unpredictable. And every time you turn on the news, someone is either getting rich or losing everything. So most people do nothing. They keep their money in a savings account. They tell themselves they'll learn later. They wait for a sign that it's safe. And while they wait, inflation quietly eats their savings. Here's what nobody tells beginners. The stock market is not a casino. It's not a place for experts only. And it's not something you need to understand perfectly before you start. The stock market is a system that has returned an average of 10% per year for the last 100 years. Through wars, through recessions, through pandemics, through crashes, 10% every year, on average. And most people never use it. Today, that changes. This is the only guide you need. Let's go. Here's the real problem. Most beginner content about the stock market falls into two categories. Category 1, too simple. Just buy stocks and get rich. No explanation, no system, no risk management. Category 2, too complex. P/E ratios, moving averages, options trading, technical analysis. Overwhelming for anyone who just wants to start. So beginners end up stuck in the middle, too scared to start, too confused to learn, and the years pass. Here's what that costs. If you invested $300 per month starting at age 25, at 10% annual return, you'd have $1,976,000 at 65. If you started at 35 instead, same $300 per month, same 10%, you'd have $678,000. Same monthly investment. 10 years later, $1,298,000 difference. Not because the market changed, because you waited. Every year of confusion is a year of compounding. Gone. Why do most beginners never start? 3 reasons. Reason 1, they think they need to pick the right stocks. This is the biggest myth. The image of stock market investing, watching tickers, picking winners, timing the market, is not how most wealth is built. That's trading. Investing is different. Investing is buying a small piece of hundreds of companies and holding it for decades. No picking, no timing, no guessing. Reason 2, they're waiting for the market to be safe. The market is never perfectly safe. In 2008, wait for the crash to end. In 2010, wait for the recovery to stabilize. In 2020, wait for the pandemic to pass. In 2022, wait for inflation to cool. In 2026, wait for things to settle. There is always a reason to wait. And every reason to wait is a year of growth you don't get back. Reason 3, they think they need a lot of money to start. You don't. Fractional shares exist. You can buy $1 worth of Amazon, $5 worth of Apple, $10 worth of the entire S&P 500. The barrier to entry has never been lower. The only real barrier is the decision to start. 3 things beginners say when they think about investing. Counter 1, the market could crash and I'll lose everything. Let's look at every major crash in history. 1929, Great Depression. Market dropped 89%. Recovery time, 25 years. 1987, Black Monday. Market dropped 34%. Recovery time, 2 years. 2000, dot-com crash. Market dropped 49%. Recovery time, 7 years. 2008, financial crisis. Market dropped 57%. Recovery time, 5 years. 2020, COVID crash. Market dropped 34%. Recovery time, 6 months. Every single crash was followed by a recovery, every single one. The market is never permanently lost. The people who lost permanently were the ones who sold during the crash. The system rewards patience. It punishes panic. Counter 2. I don't know which stocks to pick. You don't need to pick stocks. That's the entire point of index funds. An index fund buys every stock in a given index, automatically. S&P 500 Index Fund owns a piece of 500 companies. Apple, Microsoft, Amazon, Google, Johnson & Johnson, Visa, JP Morgan. All of them, in one purchase. If one company fails, 499 others carry the fund. No picking required. Counter 3. I'll lose money I can't afford to lose. This is a real concern, and it has a real answer. Only invest money you don't need for 5 or more years. Emergency fund first. High-interest debt paid first. Then invest. Money you need in 1 to 2 years does not go in the stock market. Money you won't touch for 10 years almost certainly grows. The rule is simple. Time in the market. Not timing the market. 5 steps. This is the complete system. Simple enough to start today. Powerful enough to build real wealth. Step 1. Understand what you're actually buying. When you buy a stock, you buy a small piece of a real company. Apple sells iPhones. You own a piece of that business. When Apple grows, your piece grows. When you buy an index fund, you buy a small piece of hundreds of companies. The S&P 500 tracks the 500 largest companies in America. When the American economy grows, your index fund grows. You're not gambling on a number. You're owning a piece of the economy. That's a completely different thing. Step 2. Open the right account. 2 types of accounts matter for beginners. Account 1, tax-advantaged retirement account. If your employer offers a 401k, use it first, especially if they match contributions. Employer match is free money. If your employer matches 3% and you contribute 3%, your real return starts at 100%. Before the market does anything. If no employer 401k, open a Roth IRA. Roth IRA. You invest after-tax money. It grows tax-free. You withdraw tax-free in retirement. $7,000 per year maximum. $8,000 if you're 50 or older. Account 2, regular brokerage account. For money beyond your retirement accounts. No tax advantages, but no restrictions either. Platforms, Fidelity, Vanguard, Schwab, all reliable. Open the account. That's the most important step. Most people never open the account. Step 3. Choose your investment. For beginners, 1 investment. S&P 500 Index Fund. Ticker. VOO, Vanguard, or SPY, or IVV. This single fund owns 500 companies. Has returned 10% average annually for 100 years. Costs almost nothing in fees, 0.03% per year. Requires 0 expertise to hold. That's it. 1 fund. Not 10 stocks. Not crypto. Not the hot tip from a friend. 1 fund. Build everything else on this foundation. Step 4. Automate the contribution. Set up an automatic transfer. Every payday, a fixed amount moves from your checking account to your investment account and buys the index fund automatically. You don't think about it. You don't decide each month. You don't check the market first. It runs. This is called dollar cost averaging. You buy when the market is high. You buy when the market is low. Over time, Your average purchase price is lower than the market average because you bought more shares when prices were low, automatically, without doing anything. Step 5. Do not touch it. This is the hardest step. The market will drop. It always does. It will drop 10%. It will drop 20%. One day, it will drop 30%. And every instinct will say, sell before it gets worse. Don't. Here's why. If you invested $10,000 in the S&P 500 in January 2020, right before the COVID crash, by March 2020, your $10,000 was worth $6,700. Terrifying. If you sold, you locked in a $3,300 loss. If you held, by December 2020, your $10,000 was worth $11,800. Positive return. In the same year as a global pandemic, the people who lost sold. The people who won did nothing. Doing nothing is the hardest and most profitable move in investing. Let's make this concrete. 3 people, all starting today, all investing in S&P 500 index fund, all earning 10% average annual return. Person A, $100 per month, 10 years, $20,484, 20 years, $76,570, 30 years, $226,049 from $100 a month, $36,000 total invested, $226,049 returned. Person B, $300 per month, 10 years, $61,453, 20 years, $229,710, 30 years, $678,146. From $300 a month, $108,000 total invested, $678,146 returned. Person C, $500 per month, 10 years, $102,422, 20 years, $382,850, 30 years, $1,130,243. From $500 a month, $180,000 total invested, $1,130,243 returned. $1 million. From $500 a month. Not from picking the right stock, not from perfect timing, not from luck. From a system, running automatically, for 30 years. The stock market doesn't require genius. It requires consistency. Everything above works, unless you make this one mistake. Panic selling. Here's what the data shows. The average investor, because of panic selling, earns 4.3% per year. The S&P 500, left untouched, earns 10% per year. Same market, same fund, different behavior. 5.7% difference per year. On $300 per month over 30 years. 4.3% return. $252,000. 10% return. $678,000. $426,000 difference. From panic. The market doesn't destroy wealth. Panic destroys wealth. The system is simple. Buy the index fund. Automate the contribution. Ignore the noise. Wait. That's it. The investors who follow this win. The investors who don't fund the ones who do. You came here as a beginner. You leave with a system. 5 steps. Starting today. Step 1. Open a Roth IRA or 401k. Fidelity, Vanguard, Schwab. Takes 10 minutes. Step 2. Choose one fund. S&P 500 Index Fund, VOO, SPY, IVV, any of them. Step 3. Set up automatic monthly contribution, whatever you can afford. $50, $100, $300. The amount matters less than the habit. Step 4. Set a reminder, once per year, to check your account. Not once per week, not once per day, once per year. Step 5. Do not sell when the market drops. Read that again. Do not sell when the market drops. The drop is temporary. The recovery is historical. The patience is profitable. The stock market is not complicated. It's made to look complicated. So you stay out, while others stay in. The people building wealth are not smarter than you. They're not luckier. They just started. They opened the account. They set the automation. They ignored the noise. And they waited. That's the entire secret. The market rewards the patient. It always has. You don't need to understand everything to start. You just need to start. The system does the rest.